I am Priya, Assistant Professor in Commerce CA. Now I present the topic is Accounting Concept and Principle. Meaning of Accounting Principles. Accounting principle refers to the rules and action adopted by the accountant globally for recording accounting transaction. These are classified into two categories. First one is accounting concept and second one is accounting conventions. Accounting concept. Accounting concept include the assumptions and condition on which the science of accounting is based. They are also known as the accounting standards. And second one is accounting conventions. The accounting convention include the customs and tradition that assist the accountant in preparing an accounting statement. They are following items as accounting concept and convention. That first one is business entity and money measurement, stable monetary unit, going concern, historical cost, prudence, convention, materiality, objectivity, considency, accrual, matching, realization, uniformity, and disclosure. Now I explain the business entity. Meaning of business entity. The business and its owners are two separate extensive entities. Any private and personal incomes and expenses of the owners should not be treated as income and expenses of the business. Examples for business entity. The first one, insurance premiums for the owner's house should be excluded from the expenses of the business. And second, the owner's property should not be included in the premises account of the business. Any payment for the owner's personal expenses made the business will be treated as drawing and reduce the ownership's capital contribution in the business. The next slide is money measurement. Meaning of money measurement. All transactions of the business are recorded in the term of money. It provides a common unit of measurement. For example of the money measurement, market conditions, technology changes, and the efficiency of the management would not be disclosed in the account. Going concern concept. The meaning of going concern. The business will continue in the operational extensive for the foreseeable futures. Financial statements should be prepared on a going concerns basic useless management either intend to the liquidate and the enterprises or the cases trading or has no realistic alternative but to do so. Example for going concern. Possible losses from the closes of business will not be anticipated in the accounts. Prepayments, depreciation, provision may be carried forward in the extraction of proper matching against the revenue of future periods. Fixed assets are recorded at the historical cost. And other slide is historical cost. Meaning of historical cost. Assets should be shown on the balance sheet at the cost of purchase instead of the current value. For example, the cost of fixed asset is the recorded at the day of acquisition cost. The acquisition cost include all expenditure made to prepare the asset for its intended use. It includes the invoice price of the asset, freight charges, insurance or installation cost. And next slide, prudence and conventism.
Anticipated. Only realize the profit with it.
Meaning of prudence and conventism. Revenues and profit are not anticipated. Only realized profit with reasonable certainty are recognized in the profit and loss account. However, provision is made for all known expenses and losses whether the amount is known for certain or just an estimation. This treatment minimizes the reported profits and the valuation of assets. For example, stock valuation sticks to rules of the lower of cost and net realizable values. The provision for doubtful debt should be made. And then third one, fixed asset must be depreciated over the useful economics lives. And the next one is materiality. Meaning of materiality. Immaterial amount may be aggregated with the amount of a similar nature or functions and need not be presented separately. Materiality depends on the size and nature of the items. For example, small payments such as postage, stationeries, and cleaning expenses should not be disclosed separately. They should be grouped together as sundry expenses. The second one, the cost of small valued assets such as pencil sharpeners and paper clips should be written off to profit and loss account as revenue expenditures, although they can last for more than one accounting period. The another one is objectivity. Meaning of objectivity. The accounting information should be free from basis and capable of independent verifications. The information should be based upon variable evidence such as invoice or contract. For example, the recognitions of revenue should be based on variable evidence such as the delivery of the goods or the issue of invoice. And another slide is considency. Meaning of considency. Companies should choose the most suitable accounting method and treatments and consistently apply them in every period. Changes are permitted only when the new method is considerable better and can reflect the true and fair view of the financial positions of a company. The changes and its effect on profit should be disclosed in the financial statement. Example for consistency. If a company adopt a straight line method and should not be changed to adopt the reducing balance method in other period. If a company adopt the weighted average method as stock valuation and could not be changed to other method. For example, first in first out method. And other one concept is accrual and matching. Meaning of accrual and matching. Revenues are recognized when they are earned but not when cash is received. Expenses are recognized they are incurred but not when cash is paid. The net income for the period is determined by the subtracting expenses incurred from the revenues earned. For example, expenses incurred but not yet paid in current period should be treated as accrued expenses under the current liabilities. Expenses incurred in the following period but paid for in advance should be treated as prepayment expenses under the current asset. Depreciation should be charged as part of the cost of fixed asset consumed during the period of uses. And the next one is problem in the recognitions of expenses. Normally, expenses represent resources consumed during the current period. Some cost may be benefit several accounting period for periods. For examples, development expenditure, depreciation on fixed asset. And other one is recognition criteria for expenses. Association between the cases and effect. The first, expenses are recognized on the basis of a direct association between the expenses incurred on the basis of a direct associations between the expenses incurred and revenues earned. For example, the sales communication should be accounted for in a period when the product are sold, not when they are paid. And second one is systematic association of cost. When the cost benefits several accounting period, they should be recognized on the basis of a systematic and rational allocation method. For example, a provision for depreciation should be made over the estimated useful life of a fixed asset. And third one, immediate recognition. If the expenses are expected to have a no certain the future benefit, or when without the future benefit, they should be written off in a current accounting period. For example, stock losses, advertising expenses, and research cost. And the next one is realization. Meaning of realization. Revenue should be recognized when the major economic activities have been completed. Sales are recognized when the goods are should not sold and delivered to customers or service are recognized. This slide was recognitions of revenue. The realization concept developed rules for the recognitions of revenue. The concept provides that revenues are recognized when it is earned and not when money is received. A receipt in advance for the supply of a good should be treated as prepaid income under current liabilities. Since the revenue is a principal component in the measurement of a profit, the timing of recognition has direct effect on the profit. The slide is recognition certain for the revenue. The under the certain profit should not be estimated, whether as reported profit must be variable. Revenue is recognized when first one, the major earning process substantially has been completed, and second, further cost for the completions of the earning process are very slight or can be accurately ascertained, and third, the buyer has admitted his liability to pay for the goods or service provided, and the ultimate collection is respectively certain. For example, goods sent to our customers on sales or returns basis. This means the customer do not pay for the goods until they confirm to pay. If they do not buy, those goods will return to us. Goods on the sale or return basis will not treated as normal sales and should be included in the closing stock unless the sales have been confirmed by the customers. Problems in the recognitions of revenue. Normally revenue is recognized when there is a sale. The point of sale is the earning process is selected as the most appropriate time to record the revenues. However, if the revenue is earned in a long and continuously process, it is difficult to determine the proportion of revenue which is earned at each stage. Therefore, revenue is remitted to be recorded other than at the point of sales. And next one is expectations to the rule of sale recognition. Long-term contract, hire purchase sales. So the first one is long-term contracts. Owing to the long duration of long-term contract, part of the total profit estimated to have been arisen from the accounting period should be included in the profit and loss account. And second one is hire purchase sales. Hire purchase sales have long collection period. Revenue should be recognized when cash received rather than when the sale is made. The interest charge on a hire purchase sales constitution to the profit of transaction. And third one is receipt from the subscriptions. A publisher receives the subscription before it sends newspaper or magazines to its customers. It is proper to defer the revenue recognition until the service is rendered. However, part of subscription income can be recognized as it is the received in order to match against the advertising expenses incurred. And third and last one is disclosure.
Next.
Meaning of disclosure. The financial statement should be prepared to reflect a true and fair view of the financial position and performance of the enterprises. All material and relevant information must be disclosed in the financial statement. This slide is uniformity. Meaning of uniformity. Different company within the same industry should adopt the same accounting method and treatment for like transactions. The practice enable intercompany comparison of the financial positions. And the next one, relevance. Meaning of relevance. Financial statements should be prepared to meet the objectives of the user. Relevant information which can satisfy the needs of most user is selected and recorded in the financial statement. Accounting period concept. The accounting period concept monitor the performance of the organization periodically. One accounting period will be considered. Calculating account for more than one accounting period will be tedious. These are all of the accounting concept and conversions items. So this all proper accounting period and concept, it including a monitor performance of the organization periodically. One accounting period will be the considered, and calculating the accounts for the more than one accounting period will be tedious. Thank you so much. Thank you.